Let me show you one of the fastest ways people destroy their finances. It's called being upside down on a car loan, and millions of people are stuck in them without even knowing. When someone says they're upside down on a car, it simply means they owe more money on the loan than the car is worth. Let me give you an example. Imagine you bought a Toyota Camry. Right now, the car is worth about $20,000, but your loan balance is still $28,000. That means you're $8,000 upside down. So if you wanted to sell the car today, you would have to pay $8,000 out of your own pocket just to get rid of it. That's what people mean when they say negative equity. Your loan is higher than the value of the car. And trust me, it happens a lot more than people think. Now, here's where things get worse. Sometimes dealerships offer something called rolling your negative equity into a new loan. And it sounds kind of helpful, but financially, it's one of the worst decisions you can make. Remember the $8,000 you were upside down? Well, instead of paying it off, the dealership simply adds it to your new loan. So let's say the new car you want cost $40,000 out the door. And after rolling your negative equity, your new loan becomes $48,000. The problem is the car isn't worth $48,000. And the moment you drive it off the lot, it's going to lose value like immediately. So now you're even more upside down than you were before. And if you keep repeating this cycle, you can stay trapped in car debt for years. Banks, on the other hand, they also notice this pattern. And the more negative equity you roll over, the more risky you look as a borrower. So, if it's such a bad idea, why do dealerships even offer it? Well, think about it. Their job is to sell cars, it's not to protect your finances. And from their perspective, rolling that negative equity into your new loan solves the problem. It gets you into a new car like today. But whether that decision is financially smart, that responsibility falls on you. Now, if you're upside down on your car, don't panic. A lot of you are. But here are some options. Option one, pay the difference. If you're trading in or selling the car, the cleanest way out of this mess is by simply paying the negative equity yourself. Yes, it sucks, but it prevents the problem from getting worse. Your second option, and my biggest suggestion, you keep the car and you pay it down faster. Make extra payments and close the gap between what you owe and what the car is worth. The third and final option is you do nothing, you learn from this, and you avoid repeating this cycle. Because the real trap isn't one bad loan. The trap is rolling negative equity over and over into multiple loans. That's how people end up buried in car payments. And here's the truth about being in this mess, it doesn't happen overnight. It usually happens when people roll negative equity from one loan into another one and then another one. And before they know it, they're stuck paying for a car that isn't even worth what they owe. It sucks. So if you take one thing from this video, let it be this: don't finance yesterday's mistakes into tomorrow's car. Fix the problem once and move forward smarter. And if this video helped you understand how car loans actually work, subscribe to the channel, because on this channel, we talk about real money lessons, real mistakes, and how to make better financial decisions. See you on the next one.